Welcome to our special presentation on rules to follow in 2023 by Warren Buffett. As one of the most successful investors of all time, Warren Buffett's advice is highly sought after by investors of all levels. Today, we're going to take a closer look at the principles and strategies that he has used to generate consistent returns for his shareholders and provide you with actionable insights that you can use to improve your own investment portfolio in the coming year. So, sit back, relax, and get ready to learn the rules to follow in 2023, straight from the Oracle of Omaha himself. But before I move on, don't forget to like and subscribe for the YouTube algorithm, please. Rule number 1, invest in what you know, is one of Warren Buffett's most famous investment principles. Essentially, the rule suggests that investors should only invest in companies or industries that they understand. By focusing on what they know, investors can make better decisions and avoid costly mistakes. The idea behind this rule is that when you understand a company or industry, you're more likely to have an accurate understanding of its prospects and risks. For example, if you're an expert in technology, you might be better equipped to evaluate the potential of a tech company than someone who has no experience in the field. Similarly, if you're familiar with the retail industry, you might be able to spot a great retail investment opportunity that others might miss. By following this rule, investors can also avoid the pitfalls of herd mentality, where investors follow the crowd into popular investments without doing their own research. By focusing on what they know, investors can think independently and make their own investment decisions.
Rule number 2, be patient. Warren Buffett is known for taking a long-term approach to investing, holding stocks for many years, even decades. This strategy is rooted in the belief that the stock market, in the long run, tends to reflect the underlying fundamentals of a company. By taking a long-term perspective, investors can avoid the short-term volatility of the market and focus on the underlying fundamentals of a company. By being patient, investors can avoid the common mistake of buying high and selling low, which is a result of trying to time the market. Instead, they can buy undervalued companies and hold them for the long term, thus maximizing their returns. Additionally, by avoiding impulsive decisions, investors can avoid the emotional roller coaster that often comes with short-term market fluctuations. It's important to note that the long-term approach doesn't mean that investors should ignore short-term market movements altogether. It's important to monitor your investments and make adjustments as needed, but it's crucial to do so in a disciplined and thoughtful manner. By staying patient, investors can avoid making decisions based on fear or greed and instead make rational decisions based on their long-term investment strategy. Buffett also emphasizes the importance of avoiding the pressure of trying to match the performance of the market or other investors. He advises investors to instead focus on the performance of their own portfolios and not to compare it with others. By following this advice, investors can avoid the common trap of trying to outperform the market and instead focus on their own investment goals. In summary, by following the rule of being patient, investors can take a long-term approach to investing, avoid the common mistakes of buying high and selling low, and avoid the emotional roller coaster that often comes with short-term market fluctuations. They can also avoid the pressure of trying to match the performance of the market or other investors, and instead focus on their own investment goals. Rule number 3, be disciplined. Warren Buffett is known for his disciplined approach to investing. He follows a value-oriented investment strategy, which is rooted in the belief that over time, a company's true value will be reflected in its stock price. He also follows a disciplined investment process where he carefully researches companies before investing. By being disciplined, investors can avoid the common mistakes of chasing after hot stocks or making impulsive decisions based on emotions. Instead, they can focus on a consistent investment strategy and stick to it even when the market is going through a volatile period. By following a disciplined approach, investors can avoid the pitfalls of trying to time the market and instead focus on the long-term fundamentals of a company. Additionally, by being disciplined, investors can avoid the common trap of diversifying too much and spreading their portfolio too thin. Buffett advises investors to focus on a select few high-quality companies and hold them for the long term. By following this advice, investors can avoid the pitfalls of diversification and instead focus on the companies they truly believe in. Furthermore, Discipline also extends to the management of the portfolio. Buffett advises investors to be mindful of their own behavioral biases and to avoid common cognitive errors such as overconfidence and overreaction. By being disciplined and avoiding these biases, investors can make more rational decisions and avoid costly mistakes. Rule number 4. Be realistic about your expectations. Warren Buffett is known for his realistic and humble approach to investing. He advises investors to set realistic expectations for their investments and not to expect unrealistic returns. By being realistic about their expectations, investors can avoid the common mistake of setting unrealistic goals and becoming disappointed when they don't achieve them. Instead, they can set achievable goals that are in line with the long-term performance of the stock market. By following this advice, investors can avoid the emotional roller coaster that often comes with unrealistic expectations. Additionally, it's important to keep in mind that investing is a long-term game. While it's possible to see big returns in a short period of time, it's more likely to see steady growth over time. Buffett advises investors to focus on the long-term potential of a company and not to get too caught up in short-term market fluctuations. By following this advice, investors can avoid the common mistake of trying to time the market and instead focus on the long-term potential of a company. It's also important to be realistic about your own abilities as an investor. Buffett advises investors to be honest with themselves about their own investment knowledge and to seek guidance from professionals if needed. By following this advice, investors can avoid the common mistake of overestimating their own abilities and instead focus on the areas where they need improvement. In summary, by following the rule of being realistic about your expectations, investors can set achievable goals, avoid the emotional roller coaster that often comes with unrealistic expectations, focus on the long-term potential of a company, and be honest with themselves about their own investment knowledge. This can help them make more informed and realistic decisions, leading to more successful investments. Rule number 5. Diversify your portfolio. Diversification is a key principle of successful investing, and Warren Buffett is a strong advocate of diversifying your portfolio. By diversifying, you spread your risk across different types of investments and industries, which can help to protect your portfolio from market downturns. This can be especially important when the market is volatile, as it can help to mitigate the impact of any individual stock or sector that may be performing poorly. Diversifying your portfolio can also help to increase your returns over time, as it allows you to invest in a variety of companies and sectors that have different growth prospects and risk profiles. And there you have it, the rules to follow in 2023 as suggested by Warren Buffett. Remember, investing is not a get-rich-quick scheme, it's a long-term strategy. By following these principles, you can improve your chances of success in the stock market and achieve your financial goals. Always do your own research, understand the businesses and industries you are investing in, and have a clear investment plan. We hope you found this presentation informative and valuable, and we wish you the best of luck in your investing journey. Thank you for joining us today, and we look forward to seeing you.